Hi, everyone. Welcome to day 3 of Future Proof and to our panel on the Fed. I'm Annie Massa, and I have 3 illustrious panelists with me here today to discuss one of the most important topics on everyone's mind. When they told me that this was my panel topic, I was like, no pressure on that one. So let's get right into it. There's only one place to start this panel. We've got today's CPI data that just came in, and it was higher than expected. So what I would like to hear from you 3 is what should we make of the print, the higher than expected print, and how surprised were you, if at all? Brenda, do you want to start us off?
I'd say when we were looking at all these other ancillary measures of inflation, especially things like food commodity prices, we were really expecting to see more improvement on the core inflation number. So yeah, it was pretty surprising that we didn't, and it actually got a little bit worse. So I would say from that standpoint, this is disappointing, although it is one data point, so I don't want to put too much emphasis on 1 month of data, but I think it's clear to me that we still have a demand problem, meaning demand is just too high. And so I think the economy does need to slow more in order to slow demand. So we do see prices coming down. And also, obviously, the shelter category is a big question mark because so many markets now, it's more affordable to rent than own, and that's a problem. With more people going after more, a finite number of rental units, that's going to cause rent inflation to continue rising. So I think it's a complicated story, but I don't think it means you can't get involved in financial markets and stay invested. I think there's absolutely opportunities that are being presented, especially on a day like today, where as we look going forward of how would we want to be positioned, we think that as time goes on, especially over the long term, we think bonds are more interesting than they were a year ago. A year ago, we were telling our clients, don't expect much from your bond portfolio in terms of any return. It's going to be a volatility dampener, and that's about it. But during the last week of the second quarter, we did actually add some long duration treasuries to our portfolio. And we felt that the yield curve would likely continue to invert, and that's what we're seeing today. So I think there is oddly more safety at the long end in this certain environment. And if we do slip into a recession, we feel that that's an asset class that's really going to be protective. If we see long-term rates start to come down a little bit, that's going to cause a nice price return in addition to the yield. And on the equity side, we think that if we look at the broader landscape, we've had this shift towards more value-oriented sectors over the last couple of years that have really been leading the market. But we think as we are entering and in the midst of this slower economic growth period, that investors are likely to shift back towards high-quality growth companies. So on a day like today, when a lot of those are having a terrible day, the NASDAQ down as much as it is, we think it's an opportunity to start transitioning in that way.
Totally. So definitely a bit of a negative surprise on that core CPI.
Absolutely.
Harley, what were you thinking when the print hit?
What I'm thinking right now is this is a pretty good place to be.
That's true. You know what? We have no worries. Prices are rising, but we're here.
Usually you're in an overly air-conditioned studio. This is all right. Surprised but not shocked.
Right.
The team transitory has got to kind of give it up. Inflation, it's going to keep going, and the market is pricing the wrong numbers going forward. Housing makes up a third of CPI, top line CPI. It's done by OER, owner's equivalent rent. It's not the house price of a house. It's some kind of calculation that imputes it. It lags 4, 5, 8 months behind house prices. So house prices were up 20-odd% last year. So we just know OER is going to keep on going. Even if house prices come down, it doesn't matter. It's 6 months behind the house price. So that's kind of cooking underneath. Labor, it's tight. The labor market's tight, and I'm not sure where you guys shop or services you're trying to get or any kind of other function you're trying to accomplish, but you can't get people to work right now. Is it linked to immigration policy? Yeah, sure. But whatever it might be, labor is not backing off. So we had, gas down for a few months. That's nice, but I'll make the bet that it's higher come December, and Putin is not going to go and help the home team. So inflation's going. The idea that the Fed's going to take rates up and then bring them down next year as the market's pricing in is kind of silly. How high the Fed goes, I guess, that'll be your next question. We can talk about that next. But I would say that the grand worry for all of us here in terms of investment allocation and thought is not per se are stocks going up or down or bonds going up or down, but what is the correlation of stocks to bonds? We do 60-40 in this audience here because they kind of balance each other out. There's a negative correlation between the two. I won't call it evidence or a fact. I'll just say it's a really good looking chart that when you get interest rates above 4.5, that correlation flips and stocks and bonds go up and down together. And you'll look back at the two last times we've had that correlation flip where they go in unison was in March 2020 and then November, December 18. Both times the Fed came to the rescue because all the levered money all blows up. All the risk parity guys, they all blow up. Is that going to happen now? I don't know, but I sure am worried about it. And so I'll just drop the. I can drop tickers here, can't I? You should look at our PFIX ETF, which is basically it's the hedge against interest rates. It's not that I'm bearish on rates and they're going a lot higher, and I think you're right, the curve's going to invert a lot more. But if we do get higher back-end rates, it's going to be really sorry for financial assets, and you should be very thoughtful about that.
And Gene, I want to move to you next. What were your key takeaways this morning?
Okay, I know I'm going to sound like a whack job, but the Fed pivot is still on. We can continue to believe the Fed pivot. So you think about the report that came out today. The report came out higher than expected. But if you look at every report that we've seen, whether it's survey data, PCE, manufacturing inflation data, think about this. PMI for ISM services, a 19-month low. All this data suggests disinflation. The CPI report something was off with it. So we're looking at the report more in depthly. We think something's off. Something's off in that report. Think about this. Energy down, gas down 11% last month. Food was down. Food was down, like milk, eggs were down, but still we saw a rise in food prices. Used cars were down 10 basis points, but the Manheim Index came out a couple days ago and said used cars were down 4% in the month of August. The data seems off, and I agree with you with owner's equivalent rent. Yes, rent is moving higher, but one thing we look at, there's a website called apartmentlists.com, has great data on asking rents. Think about things like the cash market of rent versus the future market of rent, the futures market. If you look at askingrent.com, asking rent on apartmentslist.com, it shows a significant drop in future rent expectations. Landlords are cutting rent. So I think the whole pivot, our expectation is that inflation will roll over pretty quickly. We're not saying deflationary, we're saying disinflationary. You can look at, again, the effect of rising rates on our economy. We still haven't felt the full effect. It takes about 18 months to get everything through our economy. You look at goods prices. Goods prices are starting to roll over. We saw apparel actually rose, but think about the bloated inventories at Target, at Walmart. All the clothing inventories are bloated. We haven't felt the effect of lower prices yet, of sales. We're going to have a ton of sales. Halloween sales, Thanksgiving sales. Sales are going to push CPI down. Also, you look at airline fares are starting to roll over a bit. So again, we're pointing to all this data to say that CPI is a little bit older data. The survey data, the forward data looks a lot better. We talked about positioning. So therefore, what's our actionable investment advice? So this growth market that we're in right now, this economy we're in right now, it's a lot different than the last one. The last one, the expansion lasted 10 years, 120 months, the longest expansion in the history of our country. In that environment, growth did really, really well. It has stretched out economic environment. Large cap growth is a perfect type of investing for that time period. The thing that we see now is much more inflation, much higher growth. And in that type of period, value looks great, so we're overweight value versus growth. We're also taking bigger positions in small cap. We're overweight small cap. Small caps are extremely cheap right now. We're also, to mitigate market volatility, we're buying a lot of liquid alternatives. So we're using a multi-manager portfolio and a global long short. And then speaking of fixed income, this is a fixed income panel. We are looking to increase our duration within our portfolio. We're still below benchmark duration, but we're raising our duration because we do think the 10-year is pretty near its top for the year, or has been at the top of the year. So
one thing I want to ask you to that point is, when we're all here back at the beach a year from now, is inflation going to be as big? Will it be a panel topic?
I will be talking about how inflation is rolling over. One thing we've talked about before is that inflation, we all know what drove inflation. People staying at home. I bought 12 Peloton bikes, supply chain issues. Everything was really affecting us. The biggest
Hey, if anyone needs a Peloton, you know the guy to talk to
They're
after
half
the
price.
panel.
Can't get rid of them. But the most important thing we talked about is household formation. Everyone talks about all these issues that drove inflation. Household formation is the biggest issue that causes inflation concern. Think about this. Household formation for the last 50, 60 years, steadily moving higher. All of a sudden, we had the pandemic. We had no idea how long the recession would be, how long we'd be stuck at home. Basically, people moved in with their parents. They took on roommates. So we lost about 1.8 million households around September of 2020, from beginning of 2020 to about September of 2020. Then June of this year, we've got that plus an additional 800,000 households. So what's that mean? Basically, everyone's rushed out of their house. They moved away from their parents and said, I got to buy a house. I got to buy an apartment. All this stuff created this owner's equivalent rent, this push up in prices. We do believe that some of this will start to slow down. We'll go back to the pre-COVID type of inflation where, goods inflation is slowing down, where we're not spending as much money. So again, we see an environment where we go back to inflation being a little bit lower than expected down the road.
Okay, so that's a hopeful outlook. I want to get our other panelists weighing in on this. A year from now, Harley, where do you see the inflation level being? Will it rise to the occasion of us needing a panel on it?
I want to know what head shop you were at last night.
It was amazing.
We're going to talk a lot about inflation, in the next year, because that's going to tail the tape. If it's still running at a 4 or 5 handle, it's not going to be 8. Okay, you're right about that, but it ain't going to be 2 either. And if it's still at 4, then the Fed's going to have a hard time dialing back. So that's going to be the conversation there. What I'm curious about is, with the information you're looking at, which I will agree is factually true. Did you foresee inflation like this 8 months ago, or were you on team transitory that was going to come back down?
Oh, no. So last year, we were screaming the Fed should not be transitory. To use your line, what was Powell smoking? We had no idea. We kept screaming to our advisors, inflation is not transitory. And to play this in effect, we created something called the Fed monitor. We take 12 variables, we squeeze them together and create a dial to say, here's what the Fed is doing, here's what they should be doing. They should be this much more aggressive. And
so how crazy is the Fed right now, kind of?
Exactly. I mean, Powell, today, Powell's hair must be crazy frizzy. He's like, what am I going to do? So, and obviously today.
Joe Biden's too, probably.
Yeah, Biden has a great speech today.
Yeah.
Great timing of a speech, so.
And Brenda, I want to bring you in too.
Sure.
What do you think, a year from now, where will inflation be, and how seriously will we be, focused on it compared to this year?
I think it'll be moving the right direction, but I'm not convinced it's going to be back at 2% a year from now, because we do have things like the owner's equivalent rent, and that was really slow to show up in inflation when we saw these phenomenal increases in home prices year after year. So I think it's going to be slow to come back down too. But I think it all depends on just how much the Fed's actions impact the economy. I mean, if the Fed funds rate is at 4% by the end of the year, for example, and that does cause more economic slowing and that slowdown in demand, I think obviously we're going to get to that inflation target sooner. But I think that's the biggest question mark we all grapple with, is just how are the Fed's actions ultimately going to impact the economy? We haven't seen a lot of impact yet, but it's early. And to Jean's comment, it takes a while for it to really be felt. So I think we need to sit with the higher rates for a while and understand just how much they're impacting the economy and demand before we'll really have a clearer picture. So I think it's going to be moving the right direction. Will it be back to 2%? Probably not, unless you really see a significant economic slowing starting to happen.
And so to the point of why we're all here, I mean, State Street has data that shows that 3/4 of financial advisors have their customers, or 3/4 of people using a financial advisor are asking their financial advisor about inflation. Probably the other quarter should consider their priorities, but no offense to them. So I'm curious, and you've all touched a little bit on this, but I'd like to hear in a more focused way, what are your best, most actionable ideas for what financial advisors should be thinking about as they're talking to clients about how to navigate this environment? Harley, you want to start us off on that one?
Sure. What's interesting is we have this, on this panel over here, uncertainty. There's a good story either way about what might happen, not only even if we haggle about what the Fed's going to do, it's unclear what inflation will do, what the Fed's going to go and do. And what's kind of surprising to me is that implied volatility, the price of options, the price of uncertainty, is relatively low. The VIX trading at 22, 23, that's barely above its long-term average of 20. The move is at 120, which is high recently, but over the course of time is not crazy. Two's just moved up, 19 basis points today. So I guess my comment is I would not be short optionality. I would not be short convexity. I would not be in a position where my portfolio can go down more than it can go up. And so either A, you add optionality, you add convexity by the things you buy, or you reduce exposure. So like junk bonds are certainly problematic just because of the profile. They can go down more than they can go up, and other assets accordingly. I mean, what we do at Simplify is we basically take optionality and jam it into an ETF. We add in convexity via structure or via just outright option purchases. So you're spending some money doing that, but you are basically creating a profile where you have some protection on the way down. And I would go through your portfolios and be looking for ways where you have trapdoors, where you're short some tail event option. Don't be short those. If you're selling a big option like buying a mortgage bond, which I think are very cheap right now, I'm good with that. But tail options, don't be short those.
Brenda, what would you tell financial advisors about how to help position their customers right now? You were mentioning looking out for those longer duration bonds.
Right, and I think, we can't take this year and assume this is the state we're going to be in for a long time going forward. We have to look at what opportunities are being presented, but similarly on the Treasury side, but if you look at municipal bonds, for example, California municipal bonds, you have a tax equivalent yield now that's approaching 5%, or in many cases over 5% for high quality bonds. So, I mean, that's something that for someone that might be retired, looking for that income, that's a decent place to be. Is it going to keep up with inflation right here and now? No. But we think that over the longer term, it's not a bad place to be. But we still are, we're constructive on the equity market too. When we look at the health of corporate America, look at corporate earnings, they're still, intact and growing. So we think there are a lot of opportunities that have been being presented right now in the equity market as well. So we think pick your spots, but I'd also add, the other asset class that we've had that people hated us for years until the last few years was commodities exposure. But commodities have been a tremendous asset class this year. I think they're up about, the broad basket's up about 20%. Yes, we've seen some commodity prices come down, but I think that's also a place you want to consider having a little bit of exposure because there are, in many cases, within the commodity complex, just these structural supply-demand imbalances that are here to stay. And we might see prices fluctuate, but they're likely to stay above where they have been historically. So I think thinking about that added diversification is important, and then picking your spots. But especially, I would say, don't be as afraid of bonds as everybody wants to be, because I think there are some opportunities out there in municipal bonds, and then for protection on the Treasury side.
I would just jump in here that I think that you're dead on right. There's one ticket I would do right now. It's probably 4% bonds, California AA plus under par. You can go get some used bonds. So like it was original a 30-year, it's now a 25-year, callable in 5. If you can buy that bond at 99, I just wave that in. Just be careful. Don't buy 3%, 3.5 bonds. You hit the de minimis rule and you're very sorry. But I think you're dead right. Muni bonds are near par, are a great idea.
Jean, you're unflappable in the face of surprisingly high core CPI. What are your best actionable thoughts for our group here?
Sure. What we tell our advisors and their clients is two things. Number one, be diversified. I mean, I know that we were in an environment, growth did really well, so we're telling our advisors to tell their clients, be very diversified. Part of that is using liquid alternatives. So you think about the markets have been up 35 of the last 42 years, but the average intra-year loss is 14%. So markets are extremely volatile. So a lot of clients don't remember this. Volatile markets, you need to stay in the market. The second thing is basically make sure that your clients' portfolios are aligned with their objectives. We've seen big swings in the market. Either clients are too conservative or too aggressive. Be aligned with your long-term objective. With all this said, our best investment ideas from a sector standpoint, I know we've talked fixed income, we've talked broadly speaking. Our favorite sectors are number one, industrials. We think industrials are fairly cheap. Industrials are attractive because think about agriculture, think about defensive stocks. Those will do pretty well for industrials. Number two, we like consumer discretionary. Everyone hates the consumer right now, but you look at the services side of the economy, people are still spending money. So we like the consumer discretionary and valuations are pretty cheap. The third area, we like technology. I know you talked about technology. We love technology. In a way to drive productivity higher, companies are going to spend money. They're going to raise capital spending on technology. Technology is fairly cheap, and there's some good buying opportunities there. So those are our three favorite sectors. And one thing I'm not a fan of, and I'm sorry, but commodities. We're not a big fan of commodities. We think they're a little too hard to play. And if you look at commodities right now, they're all moving in the same direction. So gold, copper, oil, they're all moving in the same direction. To us, it's a dollar play. That means the commodities are following the dollar. And it's hard to play the dollar. So we're a little worried about that.
Gene, do you like energy stocks like Exxon or Chevron? Are they at the top of the PE cycle, you think?
We don't. We don't like energy stocks. We think that, the old adage, the biggest headwind to high energy prices is high energy prices. And we're worried about energy companies. We've been out of energy companies for a while.
So I want to bring labor into it now too. With the unemployment rate, it's rising slightly, but still at pretty, historically speaking, low lows. I'm curious, why do you think that is, even in the face of inflation running pretty hot, Brenda?
Well, I think we had this period of time, right, where there was so much economic stimulus that was enacted that businesses were doing pretty well. And it depends, right? Now we're in this period of time where all the pandemic beneficiaries who spent the last 2 years scrambling to build up their businesses just to be able to thrive and service their customers are seeing that things are starting to slow down and normalize. And meanwhile, all the services-oriented industries that suffered during the pandemic are having the opposite problem. They're all trying to scramble to hire people. So we've seen this big shift. But generally speaking, I think especially for those lower paid jobs where a lot of people left the job market, whether they had health concerns or children or parents to take care of or something that caused them to leave the job market because they just weren't making enough to make it worthwhile, that we're seeing, that's, I think, where a lot of the shortage lies, especially on the services side. And that's the piece that's contributing to a lot of the wage growth pressure that we're seeing. But I think if we do have a period of time when demand does slow, I think there's no doubt that at least some of those open positions are likely to go away.
So, and where do you see the unemployment rate moving from here then?
Well, it's at historical lows, so I think
There's only one way.
there's only one way for it to go. It's likely to move higher. I mean, the Goldilocks version is, we just eliminate a lot of those 11 million open positions that haven't been filled, and then the unemployment rate doesn't really move very much. I think that's pretty unrealistic to expect. So I would think that we will likely see the unemployment rate starting to move up a little bit as time goes on. It's not a terrible thing. I mean, it's incredibly low right now, and again, that's at the heart of a lot of our inflation problems. So I don't think it necessarily spells disaster for the economy because the consumer is still in pretty good shape.
So you don't see a dramatic upswing, though, coming in
I don't see a
unemployment?
dramatic upswing, no.
Harley, how about you?
I have to hang my hat somewhere. It's on demographics, and you can't trade it, but it's the big wave. It's the pig in the python. And what you're seeing right now is the baby boomers, average age now is 64, so they're halfway through this thing. And we had the COVID, and they kind of said, I've made a lot of money in stocks and bonds. I lost my job or I quit or whatever. I'm not going back. So I don't think people are missing. I think they've left. That's the demographic, and they're out. Now, the other side, and I disagree with you about household formation, is that the millennials are getting married. They get married 4, 5, 7 years later than I did, or than our parents did, my parents, your grandparents did, and they're getting married now. And so you have this grinding of the gears of the millennials getting married, having kids, buying a house, having to go and fill that house with the car and the baby carriage and everything else, and the boomers leaving. And so you have this supply-demand mismatch here of millennials demanding and boomers, leaving. This is the exact same thing that happened in the 70s. If you look at the 70s, the great inflation was really not Johnson guns and butter. It was the boomers getting married, hitting their high, consumption area, and demanding goods from the World War II generation that was depleted for the obvious reasons. And that's happening right now. And that's another reason why this demographics is going to drive inflation to keep it at a high level and keep the participation rate low. Now, as far as unemployment, it's going to 4.5, 5.
How soon?
As fast as the Fed could take it there. I mean, look, if you break the economy down into quintiles, bottom quintile is 27,000 income, top's 141. So your middle 60 is 27 to 141. 141 and above, they can take care of themselves. And below, the government will care for themselves. 60% of the people sitting in this middle section where inflation hurts them a lot. If we have to go and have a policy where we continue inflation, we're hurting 60%. If I have to go and take 2%, 1.5%, and throw them into out of work, does that hurt? Well, I guess it doesn't hurt me too much, but I mean, yes, it hurts, and that's the trade-off the Fed's going to make. And I think they're going to go and make it to go and take unemployment up. I mean, that's how you go and cut up demand. They can't affect supply, so you hurt demand. You hurt demand by putting them out of work. That's kind of harsh, but that's what's going to happen, man.
Yeah, and they were sounding harsh at Jackson Hole, so
I mean, maybe we'll get to it next, but Powell is going to copy Volcker. Maybe not because Volcker was right, but that's what he's going to do.
Gene, before we take it there, what are your thoughts on how do you square basically this historically low unemployment with this still pretty hot inflation?
Yeah, so if you look at the last 12 recessions since World War II, the average unemployment rate has jumped 4.1%. I'm not saying it's jumping another 4.1%. We're in a very different environment. We have 5 million jobs out there more than people looking for jobs. Everyone can get jobs. Even people that don't want jobs can get jobs. And there's so many jobs out there. If you decompose the 5 million, there's, you can look at 1.2 million early retirees. You can look at childcare issues, concerns around COVID. We do believe the unemployment rate will rise. The Fed is going to get their job done. They will, slow down demand growth, although this is a supply issue. I think the important point to worry about hiring and wages and all this other stuff is that wage inflation continues to impact productivity. So you look at productivity. Right now, we're at 1947 lows. Productivity is extremely low. So right now, it's more expensive for companies to hire someone than to keep people on board that are less productive than they have in the past. So it's a very weird dynamic we have right now. The good news, the last payroll report we had, we saw more inclusion, more people join the workforce. But at the end of the day, it's going to take us a while to move it up. So again, the average is 4.1%. We just don't see it. It's going to be a slow move higher.
Where's it going to peak at?
So 3.7, maybe close to your 4.4, 4.5. I think 1% move. It's pretty straightforward.
Here's a question for you. How do you think, when you think about a soft landing, is that even still in the picture, and what would it look like? There are a lot of soft landing, growth recession. What does that actually look like in real terms, Brenda?
Yeah, I think prior to today's CPI print, there are a lot of things that were starting to align that looked like we were headed for a soft landing. But I think in order for that to really occur, we need to have economic growth stay positive, and obviously have the inflation number come down. So it's looking like that's increasingly harder to do if we get subsequent reports of inflation showing that it's just remaining sticky and high. So I think we won't really know the answer for a few more months, but that's just going to be a few more months of uncertainty for the market, right? And pontificating about whether this is going to be possible or not. But to the Fed's comments, when they're raising interest rates, it's going to cause some harm to some people and to some businesses. So I think that's going to happen without a doubt. Does it hurt the broader economy? I think we can probably get there without hurting the broader economy in a significant way, but I think it just remains to be seen.
So Harley, 4.5% unemployment, is that still a soft landing? What does a soft landing look like to you? Is it even possible?
It is possible to land a jumbo jet on a football field. It's not likely. Let's stipulate that Gene is right about all the data saying the economy is going to slow down. Let's just say that.
Very generous.
I think, the numbers are the numbers, and I think you're right. The question is, what will the Fed do about that? And the problem is this transitory, mishap they had last year has taken away their ability to go and say, hey guys, we got big inflation, but don't worry, got it under control, we have the data, we're going to go and top out now, or maybe one more hike, and then kind of bring it on down. They've lost that option. They don't have the ability to go and look forward anymore because they already missed it by so much. So therefore, all they can do is basically, as my colleague Dave Rosenberg would say, economies don't die, they get shot in the head by the Fed. And that's what's going to happen over here. The Fed's going to go and put the economy down, and they're going to keep tightening until they see that CPI number come down. Now, as a public policy concept, is that good? No, it'd be better if they did what you're saying. But I'm proposing they're not going to, because I'm thinking about Jay Powell, and let's just think about this. We know Arthur Burns gets no credit at all for stopping inflation. As a matter of fact, he lived through the high inflation. Did he raise rates? Yes, but nobody cares. They think of Arthur Burns as a toady to Nixon and letting inflation run wild. We think of Volcker as the hero who put inflation down. The reality is it was demographics that brought it down, not him. But once again, doesn't matter. The history books all say Volcker's hero. Powell is sitting here saying, I made a lot of money in this. I'm head of the Fed. I'm retiring soon. My tombstone, my Wall Street Journal obit's going to say what? It's not going to say Burns Redux. He's not going to allow that. It's going to say, Volcker second coming. And that means he's going to go and overshoot and jam us down. So we're probably going to I don't see the Fed cutting rates until we have at least 4.5 unemployment and probably it's got to be a 3 handled, right, on inflation before he does that. And it doesn't mean he's right. It's just that's what's going to happen.
I have a question, if you don't mind.
Go ahead.
Yeah. For you, when you look at the Fed and the position they're in, even with today's CPI number, if we look at what's actually happening in the housing market in a lot of markets, it's at odds with what's showing up in the inflation figure. Do you think the Fed is just going to ignore those sorts of real-world data points and focus solely on the CPI and just charge on without pausing for a moment to see how everything is impacted and waiting for the data perhaps to catch up with what's actually happening in the real world in some places?
I think the greatest public policy disaster has been the Fed basically took housing prices up because they took mortgage rates down, and they made it, nobody buys a house. Well, maybe some of you guys buy a house, but really you sign up for a 30-year interest payment and that's it. If you can afford $2,000 a month, that's what you can afford. Wages in general don't move all that much. And so the affordability is out the window, and we had this demographic of millennials needing to buy a house, and it became unaffordable all of a sudden. So how do you fix that? I mean, I'm not sure taking housing down by 20% to where it was 3 years ago is a good idea because of the leverage and everything else, but I'm not sure, what else they're going to do about this whole thing. They're going to hope for a slow, maybe they could hold housing prices flat and have wages go into it. But the housing disaster is a debacle. As a matter of fact, if you actually took just straight back of the envelope bond math of I could afford X dollars a year ago, I can afford the same dollars now, housing prices have to go down by 23% to make that work. I don't see that happening, but that's how much of a mismatch we have here from rates being 3% a year ago and 5.5% now. Just go to your Bloomberg calculator and just type it in. I'm not sure they resolved that.
So we have less than 10 minutes left, so I do want to get to a couple audience questions. Did you want to jump in there for a minute?
Yeah, so let's talk about the economy, the softest landing, and inflation. So we continue to believe that inflation is going to be disinflationary. We'll see some signs of it. CPI is very much of a lagging report. The future, like survey data, manufacturing, other data points, we're seeing it starting to roll over pretty fast. So we're optimistic around that. To your question about what the Fed will do. And we believe that the Fed will not, we're not saying the Fed's going to cut rates next year. We do believe they're going to pause. And part of it is all the rate hikes they've already imposed in the economy. Also, the stronger dollar. Dollar is up 20%. The last time the dollar was up 20% in a short time period, the Fed paused in 14 and 15. Then you look at QE, quantitative tightening. We haven't talked about that at all. All these are going to cause the Fed to start to slow down their rate hikes and even pause next year. Softish landing. Yes, we do believe a softish landing is in the cards. And we can look at 3 things. Labor market strong. Number 2, we look at We look at like interest rate sensitive parts of the economy, autos and homes. Yes, they're hurt. They're being hurt by rising rates, but they're coming off a very low, very solid foundation. Homeowners' equity is at 70%. We haven't seen this level this high since the early 80s. The third point, which I think is important, is that we do anticipate a potential recession, but what we call a rolling recession, where part of the economy is being hit. It's already been hurt, so we've seen autos get hurt. We do think manufacturing is being hurt right now. And the next area will be services. The good news, it's going to roll through the economy if we have a recession. Not a big sharp drop like 2008, like not a big sharp like 2002, a rolling recession. So we're not bullish, we're just, I guess, cautiously optimistic.
So to bring it to a couple audience questions now, and just a reminder to the audience, you can use Slido to send your questions into our panelists. One audience member had the question, isn't CPI more of a trailing indicator anyway, compared to some of these other data points you might look at and things like investor sentiment? What do you think, Brenda? How worried should we be as a result of something that could be a trailing indicator?
Yeah, it certainly is a trailing indicator. And when we look at all these other ancillary data points, it suggests that inflation should be coming down. So yes, from that standpoint, I think we shouldn't put too much emphasis on one data point that is a lagging indicator. We should spend more time looking at things that are more forward-looking, looking at the ISM surveys for manufacturing and services, for example, which are continuing to show that things are pretty darn good. Corporate earnings and forward guidance still, things are pretty healthy. Things like, the consumer's balance sheet, the total household net worth, by the way, it increased in dollars as much over the last 3 years as it did over the prior decade. So consumers are in decent shape. So I think those are all things that we should focus on when formulating our view, rather than putting all of our emphasis on a single data point that happens to be also a trailing indicator.
Harley, are we putting too many eggs in the CPI basket?
I suppose so. I mean, look, it is trailing. Markets look forward. The Fed's supposed to look forward also, but my proposal to you is they're not, because the transitory mishap, I think they're stuck working with CPI. So should they? No, but they will.
Gene?
I agree. I mean, I've said it a few times. You look at CPI as a lagging indicator. Classic example, CPI rent, it's lagging versus asking rent. It's a forward-looking indicator. We tend to look at more forward-looking indicators. Our favorite indicator, obviously, what we talked about is prices paid of the ISM. Look at like copper prices and prices like that. We look at like more daily and future looking. So
I was wondering if a plant of yours in the audience put that question in. Let's turn to another one. What could cause the U.S. dollar to soften at this point, Brenda?
Well, I think certainly if we start to see, that other countries and other parts of the world are raising interest rates, and or if the global economy really starts to grow and improve again, I think that's at this point in time not looking like a likely event. But historically, that has caused dollar weakness when the rest of the world is really experiencing more of an economic period of expansion. But I think right here and now, the only thing that's really going to cause it to weaken is when prevailing interest rates are more attractive other places, particularly for foreign buyers. So it's hard to determine how quickly that can happen, because other parts of the world, like Europe, are even teetering closer to a recession than we are. So our outlook is that the dollar is likely to remain pretty strong here, just because of a function of where interest rates are here and the health of our economy.
Harley and Jean, anything you want to add to that?
Oh, and I think Brenda hit it right in the head with interest rate differentials, definitely. The other aspect, look at yesterday. The dollar sold off yesterday pretty dramatically, and the news was, we had less geopolitical risk. Ukraine made some advances against the Russian military, and that's taken on as a bullish indicator. So the dollar weakened in that news. So, and you saw oil, commodities, and gold all rally on that news yesterday. So.
Harley, maybe one last one for you while we're just in our last 2 minutes here. Any comments on the disparity between where we're seeing U.S. interest rates and the rest of the world?
I mean, we're the biggest economy. The Fed's just taken rates up, and we have the big inflation numbers. I guess you have worse inflation in Britain, but who cares about that?
Brutal.
The reality is, as far as
they're in mourning right now.
As far as foreign exchange goes, it's really a relative value between interest rates and inflation. So if you look at the Japanese yen, all you're seeing is U.S. rates going up relative to Japanese rates. Because if you look at the 5-year forward yen, it hasn't budged. So it might be at 110 5 years out. but the spot can go from 138 to 144 because of the rate differential. So it's really it's a rate play. So the answer, as she was hitting on, is it's a rate trade. If you see U.S. rates go down hard, the dollar will come down with it.
So unfortunately, we're out of time, but thank you guys all so much for joining. Remember to stay hydrated and keep putting on that SPF. Thanks a lot.